Okay, so let's talk about the 5 reasons why the market's performance next year may be far less impressive than it has been since the low reached in March 2020, a period since then in which the S&P 500 has about doubled. Among the headwinds the markets may face are the expiration of government aid programs to offset the impact of COVID-19, rising interest rates, and supply chain glitches that have caused shortages of goods and helped fan inflation. Yes, there is an infrastructure package, which we talked about on the prior video, but that will likely not help Google, Apple, Facebook directly, or many of the large companies where many individuals and mutual fund managers park a lot of money. And because you're unlikely to find an expensive ring that you can sell at a pawn shop and make all of your dreams come true like this 7-year-old in North Dakota did, I'm going to do another video on companies that you may want to look into investing in that will likely be bolstered in a big way by the infrastructure package, so stay tuned. And if you want to be notified when I do, and that'll be the next video, please hit the subscribe button below so YouTube will let you know, and that thumbs up button below that shows your appreciation so YouTube promotes this video. So please click it and I can keep producing more videos like this one, and I really appreciate it. So for those who want a better understanding of what might drive returns just ahead, here's a list of 5 issues to track that might slow down the stock market returns in 2022. And again, watch my next video for stocks that could buck the trend. So reason number 1 that stock market returns might not be as good in 2022 as they were in 2021 is that the rush from COVID relief programs is fading. Although Congress enacted trillions of dollars in pandemic relief, those are expiring, and the results will be a radical shift in income growth for pretty much the whole country in 2022, says Brad McMillan, the Chief Investment Officer of Commonwealth Financial Network, an advisor and broker-dealer. Because consumers amassed savings during the pandemic and have shown signs of being eager to spend, analysts say that we are unlikely to see a recession. Still, next year's U.S. GDP growth, which is projected at around 3 to 4%, might feel tepid after an estimated expansion this year of about 6%. Number 2, Fed policy won't be as easy. To keep the economy from going into a tailspin, the Fed last year cut its benchmark interest rates to near zero and began large purchases of government bonds. Now, bond yields move the opposite direction as bond prices, so the buying depressed the yields, making it cheaper to borrow. But inflation in recent months has been hanging around 5% annualized. And although Fed officials say that pace will slow, they have announced a tapering of bond purchases. Markets also expect the Fed to raise its benchmark bank lending rate twice next year, perhaps a total of 0.5 percentage points, further tightening policy. And these steps would remove a large amount of liquidity from the financial system, says Steve Sosnick, chief strategist at Interactive Brokers. And it remains to be seen how the bond market reacts, he adds. But in recent months, rises in bond yields have sparked selling in equities. Number 3, corporate profit growth may lose steam. Now, corporate profits, a key ingredient in investor enthusiasm for stocks, are estimated to surge around 43% for the whole of 2021 versus last year. But think about it, the whole pandemic really put a wrench in the monkey work, so naturally there's going to be an increase this year. And that has helped to propel the market. But profit growth is slowing because of rising wages, soaring freight costs, and higher materials prices. And it is estimated at only around 7% in 2022, says Stam Stovall, chief investment strategist for data provider CFRA. Virtually every company will experience some form of cost pressure, says Eddie Perkin, chief equity investment officer at Eaton Vance Management, an asset management company. He adds that the impact could vary significantly for different sectors and companies, making stock selection a challenge. Number 4, market valuations are lofty. Now, after recent gains, the S&P 500 has a broad valuation of around 22 times 12-month forward earnings. Now, 22 times earnings is 30% above the average of the past 2 decades, according to Mr. Stovall of CFRA. Investors tend to ignore such flags when underlying conditions are favorable and there's a lot of willingness to take risk. But next year, with inflation possibly lingering and the Fed draining liquidity from the economy, investors may decide that stocks are overly expensive, says Timothy Murthy, a capital market strategist at T. Rowe Price. And the market may also prove less resilient in the face of new shocks, such as possible emergence of a more virulent version of COVID-19. So while there's a chance that 2022 could be a decent year for stocks, any flare-ups of the virus clearly poses a threat to the market, says Ryan Dietrich, chief market strategist for LPL Financial, an investment advisory firm and broker-dealer. And finally, number 5, stocks simply may be unable to repeat. So far this year, the S&P 500 is up about 25%. But when analysts track how the market has fared on a rolling basis of past decades, the data shows that strong stretches are usually followed by more lackluster periods, says Mr. Stovall of CFRA. So based on how the markets have been doing recently, the odds favor a gain of perhaps just 6% in 2022, he says. So those are 5 things that may slow stocks down overall. But hey, raise your hand if you plan on buying all stocks that are possibly for sale. Okay, since I don't see any hands going up, I assume that's nobody who's watching this video. In fact, for many years, I was a full-time professional speaker in addition to running my business, so 2 full-time jobs. And I taught real estate investment seminars, and I'd have people come up to me and say, well, what do you think about this particular property because of what the market's going to do? And I say, hey, are you going to buy the whole market? And they say, well, no. And I said, well, who really cares? If this one property is a really good deal, then buy the property. And it's the same thing with stock. If you can find a really good stock, it doesn't matter what the overall market is doing because you just care about the one that you're invested in or the ones that you're invested in. So that's the key thing. We're not investing in the entire market across the board. We're investing in one stock at a time and those stocks that could do well regardless of the circumstances or maybe because of the circumstances. In this case, if you have a great stimulus package going on and there's a company that could be bolstered by the infrastructure program, well, maybe that's where you want to park your money even when the whole market isn't doing so hot. So think about that. Think about the individual stocks you want to invest in. Do your research, and that's what you may want to do next year under these circumstances. So that's the topic of the next video, which stocks are most likely to buck the trend next year. So subscribe, like, and text a link of this video to others. Thanks for watching. This is The Business Guy.